In this video, we're going to be talking all about the bad investment advice that's swirling around right now because of the market drop. We'll talk about what kind of advice you should listen to and what kind of advice you need to just toss. Coming up next. Hi everybody, my name is Dee Burks and this is Retirement Rescue, where we talk about how to make money, save money, and live well in retirement. Well, because of the big market drop we all just experienced, there is tons of bad investment advice floating around out there right now. And we're going to talk about some of the worst that I've seen. Now, number one on my list is get it all in now. Get it in now. You're going to miss the upswing. Oh my goodness, y'all. Oh my. The idea that you're going to miss a gain really enforces that greed in people. They think, oh, I've got money sitting on the sidelines. I could make a quick buck. But guess what? The ones who thought that a week ago have now lost a whole bunch of money too. You can never time the market. That is a bad strategy. It's been proven bad over and over and over again. And what happens is people will get their money in partway through a drop. And then when it drops further, they yank their money out. They get scared because they're not thinking about long term. They're looking at that greedy idea of I can make a quick buck. Investing, no matter where you're investing, whether that be in real estate, whether that be in the stock market, wherever you're investing, it is not a short-term strategy. Those are long-term strategies. And if you just try to take a little bit, micro piece of that and time it, you are going to lose way more than you'll ever win. So that is a bad idea. So I would encourage people, stop that little greed monster that's on your shoulder and realize those people who are telling you that, they don't know more than you do. They're guessing, and they usually have a motivation for telling you that. They're selling a program that you can buy. They're teaching you some kind of class. They've got a special book deal. You need to be very, very cautious about someone who tells you to put a bunch of money in the market just because it went down. Number two, the people who are telling you, oh, I know the real deal. I know the real secret. You have to do it the way I'm doing it. If you are an investor and you're investing in gold, or you're investing in real estate, or you're in whatever it is they're investing in, and they're wanting you to invest in it too, they try to tell you, oh, I've got some super secret handshake that will get you into the club of exclusive investment advice. Well, that is how millionaires lost so much money with someone like Bernie Madoff, because he told them he had the inside scoop. It is really dangerous in a down market because people panic and they want to put their money where they feel like it's going to make money, or they want to work with someone who they feel like has some sort of inside knowledge, which is illegal, by the way. But they want to work with someone who's going to give them an advantage. And here again, that's really, really dangerous. Because number one, that person could be running a Ponzi scheme like Bernie Madoff was, and you lose absolutely everything. Or that person doesn't know any more than you do. So, you never invest scared money. If this is money you cannot afford to lose, and I mean lose, you should not be investing it. And that really kind of brings up number three, which is do not borrow money to invest. This is not the time to do that. Leveraging money to invest, this is not a good time. Not a good time. What happens if you pull money out or get a loan, or worse, pull it off a high interest credit card because you're convinced you're going to make a quick buck and the market continues to fall further? You're going to not only owe money that is now being charged an incredibly high interest rate, but you're going to be losing that money hand over fist. Never borrow money, especially when the market is uncertain. It's not that it's just dropped, it's uncertain. It's going to be volatile for a while. So don't use leverage. Don't get into things like commodities or things that like precious metals that you don't know much about. Now is not the time to get into things you don't know anything about. Just wait it out, stick with your long-term strategy, and keep it simple. Otherwise, you could get into the real danger zone. But whatever you do, don't borrow money to invest. Now, number 4 is an all-in strategy. Like I already said, investing is a long-term proposition. Scraping together every bit of cash you have and putting all that cash into something that is a long-term investment is going to hurt you. It can feel almost wrong. You know, when you know the market's down and this is when Warren Buffett's investing. Well, he's investing money he can afford to lose, number one. And he has a tremendous amount of cash sitting on the sidelines. He's not worried about having to pull those investments out. But if you invest everything into stocks, real estate, something where you can't access that money quickly without liquidating that investment, then that is going to hurt you. You are going to need significantly more cash when things are uncertain and when the market is down during a recession than you would otherwise. So be sure you have that cash available. Okay, number 5, and this is one of my favorite because I think almost all of us are guilty of this at some point. But when you start investing, it's really easy to read one article or 2 articles and think you know what you're doing. And this is the issue called, hey, I'm the bestest. I'm above the curve. I'm above average. I know more than your average investor, so I'll do fine. No, you don't. No, you don't. There are fund managers who get it wrong all the time, and this is what they do 24/7. What makes you think that you're going to do better than them? You're not. One of the things that people don't talk a lot about, and they really should, is the fact that the market is very emotional. People buy and sell based on emotion, especially when things are uncertain, in ways they don't when logic's involved. It's really easy to say, oh, but I'm logical. And everybody is until the market crashes, and then nobody is. And so the idea that somehow you're going to keep your head while everybody else is losing theirs is crazy. You're not going to. So one of the best things you can do for yourself is not assume you know better or that you're going to do better than someone else. Again, stick to your long-term strategy. Don't do these short-term things that are going to get you in trouble. Stick to your long-term, tried and true methods and don't waver. Wavering when we have a recession like this is one of the things that gets people into a lot of trouble. And here again, it's that greed monster. That is usually the motivation behind it. They think, oh, but if I get in low, boy, I'll just make all... No, odds are you won't. And if you change what you're doing right in midstream and you change that long-term investment strategy, the odds of you losing are much higher than the odds of you winning. So just keep that in mind. Stick to that long-term strategy, the one that lets you sleep at night. And while we're on that subject, there are a number of people, and I've even gotten some comments on various videos, who are young. And when I say young, I mean under 40. That's young to me. Who are young, and they think they know. They took a class on day trading. They took a class on swing trading, which, by the way, swing trading is an extended version of day trading. But let me tell you what. In the 2008 recession, prior to that, people were day trading. Oh, it was talked about. There were big seminars on this is how you day trade. You can make millions and you could, you can work from home. That was really before work from home became a thing. It was limited because so many people didn't have good internet access, but now we do. And so in the meantime, the last 10 years, day trading and now swing trading, its evil twin, has reared its head again. Well, that is a great way to go broke. Even if you do well for a year or two and you make a lot of money, you risk going broke. It is a very, very difficult thing to do that well. And here again, a lot of the market trades on emotion, and these ideas are based on technical values of stocks. They're based on the technical charts. And there's nothing wrong with that. but those technical charts do not take into account the emotion of the market. And so you're always going to be missing that. You will always be at risk, and it is a very, very high risk maneuver. Very high risk. Nothing I would ever tell someone to do, because the odds of you doing it well are almost zero. But it takes a while sometimes for people to figure that out, because they, think they take a class and they're smarter than everybody else. I'll be better than those old guys who never really did it right. No, those old guys got their butts whipped and they learned, and now they invest differently. That's what happened. So I would really encourage you to stick to that long-term strategy. Go with investments that you really do know, that you are comfortable with, and continue along that line, and you will benefit. Now is not the time to make big changes or big deviations from your long-term strategy. That's not smart. This is one of the worst times, when things are chaotic, when things are uncertain. Those are the worst times to try and reinvent your strategy. Let things settle out over the next few months and see where it's going to lead, as far as the economy, as far as jobs, as far as where you're at financially, and then make a plan. Don't do it now when things are still in chaos. Chaos kills. It will kill you financially, and it can be a burden that you live with for literally years. So don't make that mistake. Now, if you've enjoyed this video, please click the subscribe button, hit the little bell, and you will be notified the next time we have a video. Thanks so much.